Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers and hyperbole to give you the information you need for your portfolio. Now, today I'm going to be joined by Jordan Jackson. He is a JP Morgan Asset Manager Global Market Strategist, along with the People's Producer, Sydnee Free. Give us a People's thumbs up there, Sydnee. Thank you. All right. On the docket today, we're going to be talking about the Fed. We've got a key meeting this week. No cuts or raises are expected, but lots to dig into. Also, our word of the day, supercycle. Are we in a new bullish commodity supercycle? We got cocoa, gold at records, while oil seems to have settled down. What geopolitics means for the future fabric of our manufacturing base. And also, this episode is brought to you by the number 212,000. That is the number of weekly jobless claims that Wall Street expects this Thursday, which may be more important than the monthly job numbers we get Friday. And we're going to tell you why. So Jordan, Sid, thank you for joining me here. We want to take the top story of the week. Jerome Powell and company gathering around the Federal Open Market Committee table. I'm assuming it's a big table. Now, Tuesday and Wednesday. Wednesday is a big decision day. We're not expecting any big changes, but there's a lot at stake here. And handicapping odds for the Fed rate cut, those have drastically changed from the beginning of the year, from 6 to 1 or 2 now. What do you think?
Well, I think the Fed won't be able to cut interest rates, certainly not this week, and perhaps not at all this year. And you've talked about sort of the roundabout that we've made over the course of this year. We came into the year expecting, well, at least markets were expecting 6 to 7 rate cuts this year. Our base case was for 3 on JP Morgan Asset Management. We expected June, September, December, and now that seems like even a high bar to achieve. So when you look at the underlying dynamics, remember the Fed's got 2 mandates: tight labor markets and price stability. You've got checkmark on tight labor markets, okay? Through March of this year, that marks the 28th consecutive month in which the unemployment rate has been below 4%. This is a very, very tight labor market. You mentioned jobless claims. Jobless claims have continued to run at very, very low levels, suggesting that if you want a job, you can get a job. Demand is pretty strong out there for labor. Now, on the inflation side becomes a lot more challenging for the Fed. We're seeing signs that inflation is remaining very, very sticky. If you look at, and I tend to want to look at the annualized run rates, that gives you a better sense of inflation momentum, right? Near-term inflation momentum. Sometimes the year-over-year numbers, you fall prey to base effects that kind of muddles the picture a little bit. But if you look at headline CPI on a 3-month annualized basis, that's at 4.6%. If you look at the Fed's super core measure, which they're calling core services ex shelter,
touted by the Fed in a big way and Powell last year, don't hear as much about it anymore. Give us a number. Maybe this is why.
Sure, because the 3-month annualized run rate on that figure is at 8.2%. There's just no way the Fed's got downward or disinflationary inflation momentum in order to be able to cut rates.
Yeah, I'm really glad you brought up supercore, because this was a word we were hearing a year ago when the Fed was touting the fact that inflation was coming down quite rapidly. And I think when we talk about inflation, it's easy just to kind of cast a broad net, but where there are all kinds of different components. You got the input side, and then you also have wage inflation. But on the prices side, we have the goods sector and the services sector. And you study the economy, you write about GDP for JP Morgan. Tell us what that means for investors.
No, absolutely. So core goods, that tends to be a healthy basket of commodities, so to speak, right? And that tends to be driven a little bit more by supply side dynamics. You think about the Panama Canal, Suez Canal, a lot of goods flow through these important parts of the world. And also Middle East, there's a lot of geopolitical risk happening in the Middle East. So that could also complicate a lot of these supply chains and thereby impact core goods prices. We haven't seen that happen just yet. Core goods have actually been outright deflating or prices falling for the better part of the last 12 to 16 months or so. Now, the core services, one of the reasons why the Fed has sort of focused on core services, because they believe that that is the sort of inflationary metric that is more sensitive to monetary policy, the demand side, and particularly wage inflation tending to drive a lot of what we see in core services inflation. So they think that feed through of higher wage inflation will feed through to higher core services inflation. And monetary policy is actually somewhat useful in quelling sort of price pressures, more so on the services side. But the challenge is they're not getting those easing price pressures on the services side.
No, they're, as you point out rather adeptly here, the 3-month numbers are running up at a rapid rate. Even the year over year now at least have stagnated. They're just not coming down. You mentioned geopolitics, so I want to talk about that. Arguably, we are in an era now. It seems almost a secular thing. You wonder how this is it going to be extrapolated throughout the end of the decade, but geopolitical unrest seems to be on the rise, and that usually means inflation. Talk to us about that.
Yeah, and that's kind of the risk where markets are a little bit worried about stagflation. It's a hard economic environment to sort of imagine, but it's more difficult for policymakers to adjust policy around stagflation because typically where one giveth, one taketh away. So what do you need for stagflation?
This was the 1970s, basically.
Exactly.
Which I barely lived through. I remember gas lines, but that's about it.
I wasn't even a thought back then.
Wait, let's pause for our viewers and define what stagflation is.
Yep. So stagflation, there's 3 components to stagflation. First, it's weak growth. Second, it's high inflation. Third, it's high unemployment. And it's a very challenging environment because I mentioned, as one giveth, one taketh away. Typically, the economic textbooks will tell you if you have low levels of unemployment, that should generate more inflation, right? Because as companies have to lobby for that additional worker in a low unemployment rate environment, they potentially have to pay up to attract that worker. So you get wage inflation that ties itself into higher overall inflation, and the inverse being true as well. But when we break down those 3 components, we don't think we're in a weak growth environment. I know the GDP print for the first quarter was a bit of a weak number.
It's amazing it's positive to me. I mean, after all the recession calls, it's 1.6%. That's not nothing.
Right, relative to expectations of 2.5%. But when you look underneath the hood, the big detractors for growth in the first quarter were inventories and trade. Those are 2 very, very volatile components of GDP growth. But when you actually strip those out and look at real final sales to private domestic purchasers, the economy grew at over 3% in the first quarter. So this is not a weak growth economy. As I mentioned, the unemployment rate has spent a long time under 4%. And inflation, while it's certainly seeing signs of being sticky, and I hesitate to say re-accelerating, but certainly showing signs of a lot of stickiness, that's still running at 3 to 4%, not 9% like where we're at in the middle of 2022. So this is not a stagflationary environment, but this is an environment where the Fed probably can't cut rates anytime soon.
I want to stick with central banks here and get to Japan real quickly, and then we'll move on to commodities. But some interesting developments with Japan this week. The U.S. dollar versus the yen reached 160. That means the U.S. dollar was strengthening, the yen was weakening. Yen is at the weakest point it's been since 1990, and there's lots of talk about what that means for investors. It was a holiday in Japan, so take that with a grain of salt, but it looks like authorities there are reacting to these moves in the currency market. Meanwhile, their rates are at 0.1%. They were negative a few months ago at the beginning of the year. Now they're 0.1%, and the U.S. is at over 5. Europe is over 4. That's a big gap there. So should investors in the U.S. be at all concerned about what's happening in Japan?
I think they should be. Now, when I think about currencies, I always try to remind myself there's 2 sides to every coin, no pun intended. But generally speaking, when you think about why the yen has weakened so much, not only has it been the Bank of Japan being willing to stick to very loose monetary policy. Yes, they got interest rates out of negative territory, but they're just right above 0, where everyone else, generally speaking, across developed markets, have 4 to 5% policy rates. Also, the Fed on the other side of the coin has had to shift more hawkish because the data has been a lot stronger than what ourselves and policymakers had anticipated. So this gap between hawkish Fed, more dovish Bank of Japan has led to some significant weakness in the yen. Now, from an investor standpoint, one of the challenges historically, the Japan indices tend to be heavily skewed towards multinationals. So these large companies,
big conglomerates like Sony, Mitsubishi that make everything.
Exactly, and they generate a lot of their revenues overseas. So a weaker yen tends to be good for these companies. Now that negative correlation has come down a bit, really since the course of the pandemic. But I do think that this is sort of any sort of strengthening in the yen could provide a bit of a headwind to their equity markets. Also, the Bank of Japan, while they very gradually are going to raise interest rates, they're still committing to some degree of yield curve curve control. They're saying that they're not committed to yield curve control, but they're still in the market buying JGBs to help to stabilize the market. So I think there's still some concern around Japan. I recognize the investment community may be tactically a bit more overweight, but I'm not seeing any sort of structural changes in terms of the demographics out of Japan for me to get super excited about that market over a longer term.
Sid, you're looking super excited here.
Let me ask you something. We're talking about the Bank of Japan. What's the relationships between all the central banks? Do they try to coordinate their moves? Like, they're all wanting to cut right now. Obviously, not all of us are there yet. But a couple of years ago, they were all raising. What's kind of the relationship between all of them?
So, they monitor what other central banks are doing, and a lot of times that the challenges tends to be within the currency market. Higher interest rates tend to support currencies. Lower interest rates tend to do the opposite. And you have scenarios like now where global central banks, developed markets in particular, have tightened rates very aggressively, and the Bank of Japan has tried to stay very accommodative, and that's put a significant amount of downward pressure on the yen, and that has a myriad of implications, not just for companies, but for domestic consumer confidence as well, because that tends to import some unwanted inflation on domestic consumers. So they try to maintain an independence and adjust policy rates based off of their own domestic conditions by way of labor markets and inflation. But obviously, they do care about what other central banks are up to.
They also all meet about 6 times a year in Basel, Switzerland, and this has been written about. And so there is a degree of coordination. I would say it's not always the case, though. The global financial crisis, 2008, a lot of people I hear who are from Europe say that Bernanke went rogue. Difficult to kind of parse out what went on behind closed doors, but at the end of the day, every country has their mandate, and they have to serve their populations first, at least in theory. All right, we have to take a little bit of a break here. So for our viewers on the streaming platforms, we're going to take a quick break in the following moment. For everybody else, let's carry on with the show. All right. Well, we were going to talk about commodities, and I think that's time to raise our new word of the day. It is supercycle. Now, we may or may not be in a commodity supercycle. We're going to talk about that in a second, Jordan. But I just want to talk about commodities real broadly here. We've seen an explosion in the price of cocoa, coffee, gold, silver. Some of these commodities are well off their highs, but we do have a lot of action. And then WTI crude oil, one of the more famous commodities, that's really not doing a whole lot. It's at $82 a barrel. So Jordan, do you think we're in a new commodity super cycle, or is this just a bit of strength we're seeing? And I guess, how does that play? Like, how long would you expect that?
Sure. So I don't think we're in a commodity super cycle, but I do think we're in this environment that'll play out, I'd say, over the next 5 to 7 years, in which a broad basket of commodities could be well supported. Now, keep in mind, this is over roughly the last 30 years. When you look at core goods inflation and a broad basket of commodities, that's actually been coming down, and prices actually falling for the most part. But there's a couple of reasons why I think commodities certainly deserve a share of client portfolios. One, when you think about the renewable energy transition that is probably maybe in its second or third inning in Europe, certainly in its first inning here in the U.S. In order for us to digitize or electrify the grid, in order for us to build up a lot of these solar and wind farms, et cetera, you need the lithium, you need the nickel, you need the cobalt in order to be able to do all that. And so in order to achieve the end goal of a sort of a renewable grid, you're going to need a lot of these inputs. And I think that's going to create a source of demand. We should also recognize that China has dealt with a myriad of challenges over the better part of the last, call it, year or two. And any sort of revival in the Chinese economy, whether it be domestic consumers coming back online or them sort of whipping up the old playbook and building out a lot of infrastructure, that's going to also generate a lot of commodity demand as well. And we also have to remember globally that global growth certainly had sort of struggled a little bit and continues to kind of struggle a bit over the last couple of quarters, but could certainly start to rebound. And that stronger global growth will also increase commodity demand as well. And so I think on balance, you can certainly paint yourself a picture in which, again, we may not be headed for a super cycle, but I think commodity prices could be well supported.
And commodities have a place in your portfolio, you're saying. So, a lot of people follow this 60-40 stocks and bonds. What percentage or how much should you allocate to commodities?
Sure, I'd say something like 3 to 5%. So not a huge weighting, but I think that's an appropriate sort of point.
Real quick, how much to crypto?
For those investors that have the risk tolerance, that have the longer time horizon, I think equally a 3 to 5% allocation, not just in Bitcoin, but over a diversified basket of cryptocurrencies.
5% commodities, up to 5% crypto as well, give you 10% exposure in some of these alternative investments. I come from the commodities field, and so I looked historically at correlations in the market, and the 60-40 portfolio is indeed pretty well diversified, at least more diversified with some commodities exposure. All right, we got to move on. We talked about the labor market. This brings us to our number of the day from the BLS, and it is 212,000. That's the expectation for weekly jobless claims this Thursday. And as we've been talking about, we're also getting the monthly numbers on Friday, but the weekly number might be a little bit more important, at least as a leading indicator. This is something you've written about. Tell us about it.
Sure. So we tend to like to look at the initial jobless claims number, as you've highlighted, Jared. It tends to be a good forward-looking indicator of job creation. Right now, those numbers have continued to run at very, very low levels. And this is, just a reflection of demand for labor continue to be pretty robust. We do anticipate the employment report that we get this upcoming Friday is going to show continued job strength. We think the unemployment rate is going to print 3.8%, and we think we're actually going to add about 225 to 250,000 payroll gains.
Another report with 200 plus thousand.
Another really strong report. And I think a lot of attention gets focused on the government side. Yes, government has been hiring a lot lately, but we've also seen a bit of an uptick in hiring across construction and continued hiring in the healthcare sector as well. So there is a little bit more kind of breadth in terms of the hiring. It hasn't just been, those folks who couldn't get the private sector job earlier on in the expansion are now have to opting for a government job.
Real quick, I'll say that construction jobs and manufacturing jobs tend to be leading indicators. They dip first, and they have just remained remarkably strong over the last few years. Really not a lot of cracks, but as you said, the weekly numbers, I love that granularity. You get it every week, and that is a leading indicator of when we start to see problems in the job market that we're admittedly not seeing right now. All right, I do want to keep it here with the labor market. Sid, any questions about the BLS and all these reports that we're talking about?
Yeah, well, I definitely learned something new about initial jobless claims there, because I feel like we don't ignore it, but it's just it's every week. When something's every week, I don't know, you tend to not focus on it as much as the monthly jobs report, I sort of feel like. Yeah. But when we're talking about the monthly jobs report, I'm a little confused. I keep hearing there's discrepancies in terms of what goes into this report in the BLS. There are two different places those numbers come from.
The surveys.
Yeah, the surveys.
Two different surveys.
What's that situation? I feel like that's not something everybody knows.
Yeah, so there's the establishment survey. That's where we get the non-farm payroll number from. And then there's the household survey, which is where the actual unemployment rate is derived from.
So businesses and households, basically.
Exactly. And so we have seen generally weaker numbers coming out of the household survey relative to the establishment survey. And so the establishment is generally assumed to be, there's a lot of seasonal adjustments that happen, not just on the household, but also on the establishment survey. And so when you look at, say, the beginning of the year, for an example, which is, right, seasonally, you hire a lot of folks, part-time workers, in the fourth quarter, November, Thanksgiving, Christmas, and then you lay off a lot of workers. But there's seasonal adjustments that are applied on top of that tries to smooth out that ride. And so you tend to get perhaps stronger numbers coming out of the establishment survey versus what would be signaled coming out of the household survey. I'd also, just really quickly, just adding, there's some wonky things happening in terms of how part-time work is sort of calculated across both of those. And I think that could be muddling some of the numbers also.
I would add that since the pandemic, survey numbers, survey response rates in general for all kinds of economic surveys have been depressed. So we're not getting as accurate results as we used to get. And so the revisions also tend to be a lot bigger. And then the BLS does a once per year accounting, I think it's in January, February. And that's when we see the two reports catch up. And I think in the last reading, the two reports were more or less in agreement, so some of those arguments got away. But nevertheless, it's something that seems to pop up in most employment situation reports.
Let me ask, with all this seasonally adjusted data, why don't you just not report it every month or whatever and wait till the data
10
is
years?
correct? I don't know. Don't you think it's interesting though that something could shift that much? Like I don't get it.
Well, the thing is, I think people have to make decisions based on what we know, and they'd rather do that based on flawed information than no information. So yeah, we could get perfect information once per decade. This is the rate that we had in 1990. We're sure of that. It's not going to help me. It's not going to make me decide to buy Bitcoin, although it might.
I give in.
All right. We talked about a number of economic reports. We got a couple minutes left here. It does look like it is time for another episode of Who Wore It Better? Now, this is our take on Hollywood, and today's topic is AI. We have just seen an explosion in AI interest the last year and a half, and when people say AI, we generally take them to mean tech. But the AI trade is not just tech. It's also about infrastructure. It's about the mining the materials necessary to make those chips, assembling the servers, supplying them with electricity. Investors might be surprised to learn that both large cap utilities and industrials, so two sectors, utilities and industrials, those are outperforming the tech sector this year by a large margin. I should also note that communication services is a different entity that houses Alphabet and Meta for various reasons. Both of those are in the second best sector. So kind of a jumble here, but I guess my big question to you is, which sector is wearing this AI boom the best? Is it actually tech? Is it utilities? Is it industrials? What do you think?
I think we're seeing it implemented today across a number of those different sectors, but I actually will slightly adjust the question and say who will be using AI the best. And to my response to that, I'd actually say healthcare. So I had a very, very interesting conversation with a former CFO. He's a pathologist, and he's starting his own company, but he's embracing AI in a way in which he's bringing AI imaging, and being able to analyze benign cells, but be able to establish with this imaging, which is absolutely incredible, probabilities around if these cells can become cancerous. And so you think about that sort of implementation and how impactful that could be for healthcare more broadly. And I can't imagine all these other areas in which it could be really, really impactful. And I think it's just going to be revolutionary for the healthcare industry going forward. It wouldn't be surprised in the next 15 years we'll see AI robotics doing hip and knee replacements.
You're our first guest to go rogue in this segment, and I love it. An answer that we did not expect healthcare as the biggest beneficiary of AI. Sid, you got a quick question?
Yeah. Well, so disregarding just AI, there are so many sectors that seem to deal with tech. Like two of the Mag 7 stocks are consumer discretionary.
Yeah, Tesla, Amazon.
Two are consumer services, right? Communication services, sorry. So why is that the case? Why is everything split into these different sectors when it's all just
where it's actual apples to oranges? Why is it apples to oranges?
I guess so.
Yeah, I guess it's sort of how these businesses run to some extent, right? You think about technology. It's typically been driven as a high growth sector. It's assumed to be a sector which companies are almost called by the investors to be putting capital to work. But I find it even interesting that even those are starting to change. The fact that two of the top or the Mag 7 companies are issuing dividends now. We would have never imagined seeing these large growth companies issuing dividends, 20 years ago, since many of the top performing tech companies back then were not even profitable.
I got to stop you there because we're winding things down. Conversation for another day will be continued. That's all for now. Keep it tuned to Yahoo Finance. Thank you.